I have to admit, looking at the screens this morning, I felt the urge to pour myself a drink. And it's barely noon.
I know the feeling.
It's Friday, January 30th, 2026, and if you are checking your portfolio, you know exactly what I'm talking about. The vibe hasn't just shifted. It's practically done 180.
It really has. You know, just a few weeks ago, we were using that phrase, constructive indecision.
Right.
It felt like the market was just pausing to catch its breath, maybe tie its shoes before the next sprint. But today feels, well, different. The data we're looking at suggests the mood has swung to defensive realignment.
Defensive realignment.
Yeah.
That sounds like code for run for the hills.
Not necessarily run for the hills, but definitely put on a helmet. It feels like the market woke up from a very pleasant dream about endless growth and realized it's late for a very difficult job interview.
Exactly. It feels heavy. So we have a clear mission for this deep dive. We've got the expanded swing trader report that dropped this morning, and we need to decode why the S&P is testing these lower bounds.
We're trading right around 69.45.50 as we speak.
We need to figure out what the so-called smart money is doing, because that high-tight flag pattern everyone was cheering for in early January, it is toast.
It's degrading rapidly. We've officially moved into a correction yield pressure status. The easy uptrend is on pause.
So here's the plan. We're going to break this down into three parts. First, the why. The double punch of news that knocked the wind out of the market.
And the mechanics.
Second, the mechanics. We're going to talk about yields and this concept of gamma that acts like the market's shock absorbers. And finally, the how.
The actionable stuff.
We have two very specific trading strategies from the report. One for the bears who want to profit from the drop, and one for the brave souls who think they can catch a falling knife.
And believe me, you have to be brave for that second one.
We'll get to that. But let's start with the catalyst. Why did the mood sour so fast? The report calls it the double punch.
It's a perfect storm, really. You have a micro punch, that's the corporate side, and a macro punch, which is the big picture politics. We have to start with the corporate side. We have to talk about Microsoft.
Yeah, MSFT down 10%. That is a massive move for a company that size. But is it really just one earnings miss dragging down the whole market?
Well, it's not just the math, though the math is brutal. When Microsoft falls 10%, it drags the SP500 down just by its sheer weight.
Sure.
But it's the signal it sends. Microsoft is the bellwether for AI, for cloud computing, for enterprise spending. When they miss significantly, it triggers this whisper campaign across the entire trading floor. Is the growth story over? Is the AI monetization taking too long?
So it's like the general of the army stumbling. If he falls, the troops get nervous.
Exactly.
Yeah.
It puts immediate pressure on the tech titans group, the XLK sector. And since tech has been holding this market up for so long, if tech wobbles, the whole building shakes.
Okay, so that's the corporate bruise.
Yeah.
But then we have the political one. And honestly, this one confused me a bit. President Trump nominates Kevin Warsh for Fed chair.
Right.
Usually the market loves it when a Republican administration picks their guy. Why is the market freaking out over Warsh?
That is a great question, because on paper, you'd think business-friendly. But markets are interpretation machines, and right now, they're interpreting Warsh as a signal for a more hawkish Fed.
Hawkish meaning tighter money.
Right. Warsh isn't known as a low rates forever kind of guy. He's seen as a hard money advocate, someone who worries about inflation and asset bubbles. The market loves certainty, and it loves cheap money. Trump picking Warsh signals a potential regime change at the Fed, maybe more volatility, maybe less support for asset prices.
And this comes literally 2 days after the Fed already decided to hold rates steady on Wednesday.
Exactly. So on Wednesday, the Fed says, we're pausing. Then on Friday, the political signal says, actually, things might get tighter. That whiplash creates headwinds. It's that combination corporate earnings failing to justify the high prices, and the macro picture suggesting money is getting more expensive.
Speaking of money getting expensive, let's look under the hood. The report calls this next metric the governor. And I don't think they mean a politician.
No, they mean a speed governor, like on a truck. We're talking about the 10-year Treasury yield. This is, without a doubt, the most important number on your screen right now.
Really?
If you ignore everything else we say today, pay attention to this.
The report calls it the Ganogo gauge. Where are we at?
We are at 4.27%.
Okay, 4.27%. To a normal person just looking at a savings account, that sounds fine. Why is the market treating this like a disaster? We were just at 4.19% earlier this month.
It's the rate of change, and it's the threshold. The report has a strict rule. The danger zone begins at 4.25%. We have broken the ceiling.
Break this down for me. Why does 4.27% hurt stocks?
Think of the 10-year yield as the risk-free rate. It's what the government pays you to sit on your hands and take zero risk.
Right.
When that number goes up, it becomes a fierce competitor to the stock market.
Mhm.
Right now, the S&P is trading at a price-to-earnings ratio of about 22.
Which is historically pretty expensive.
It's very expensive. Investors are willing to pay 22 times earnings for a stock when the alternative is getting paid 1 or 2% in bonds. But when the bond market offers you 4.27% guaranteed.
Suddenly that tech stock doesn't look so good.
Exactly. Risking your money on a tech stock trading at 22x earnings doesn't look so smart. It compresses the valuation.
It's just a math problem.
Precisely. The higher yields go, the less your future corporate earnings are worth today. That is what is fueling this sell-off. The risk-free alternative is becoming too attractive to ignore.
So the rule from the source material is pretty clear here. Do not initiate aggressive long swing positions while yields are consistently making new highs above 4.25%.
It's a red light. You don't speed through a red light unless you want to get T-boned.
However, and this is a nuance I found really interesting, the report says this isn't a total panic. It's not like 2008 where everyone is selling everything to hide cash under the mattress.
No, it's a portfolio rebalancing.
Or rebalancing.
Yes. If you look at the sector rotation, it tells a fascinating story. Tech, the XLK is bleeding, we know that. But capital is rotating into industrials and defense.
Defense stocks, like what? Aerospace, weapons manufacturers?
Exactly.
That seems specific.
It is very specific. And if we connect this back to the Warsh nomination and the Trump presidency, it suggests the smart money is positioning for a different kind of world.
How so?
They're moving out of the digital, cloud-based growth of the last decade and into the physical, hard economy.
Tanks and steel.
Tanks, steel, and infrastructure. It suggests they're anticipating global friction. They're betting on a world where physical security matters more than software subscriptions. It's a defensive posture, literally and financially.
That is a sobering thought. But from a market structure perspective, it means the bull market isn't dead, right? The money isn't leaving the casino, it's just moving to a different table.
Correct. It's a rotation, not an exit. But for a swing trader, trying to navigate that rotation is treacherous. You can get chopped up very easily.
Speaking of getting chopped up, let's talk about who is winning and who is losing right now. I always love the whale watching section, the Larry Williams style analysis of the Commitment of Traders report.
This is where we see who's holding the bag. We track the commercials, the hedgers, the institutions, the smart money versus the small traders, or retail.
The dumb money, affectionately speaking. So what's the setup?
Well, looking at the data from the last week, the commercials are aggressively short. As the index was hovering near 7,000, these big institutions were locking in prices. They were selling into that rally.
They saw this coming.
They correctly anticipated that the air was getting too thin.
And the retail traders.
They are caught long. Sentiment was incredibly high going into the Fed meeting. The small traders are buying calls thinking the breakout was imminent.
And now we've dropped from 7,000 to 69.45.
Which means those retail traders are underwater. They're trapped. And this leads to a very dangerous signal in the open interest data. The report notes that open interest is rising on the downside.
Translate that for us.
Usually when prices drop, open interest drops too. It's because people are panicking and closing their positions to stop the pain. But here, open interest is going up as the price goes down.
What does that mean?
It means short creation. It means aggressive sellers, sharks, are entering the market right now, betting on further declines. They smell blood.
So they're not just closing out longs. They're actively opening new shorts.
They aren't just selling to get out. They are selling to push it lower.
So we need a washout.
Yes. The market won't bottom until those trapped retail traders capitulate. We need them to panic and sell to clear the deck.
That sounds brutal, but I guess that's the game. Now let's talk about the invisible walls, the options market structure. This part always blows my mind because it dictates where the price actually stops.
It defines the playing field. First, the VIX, the volatility index, is waking up. It's around 1688, but futures are higher. Traders are paying a premium for insurance.
They're nervous.
But the real story is in the gamma levels.
Okay, gamma. This can get technical, so let's use an analogy.
Think of positive gamma, like the shock absorbers on your car.
Yeah.
When you hit a bumper price drop, the dealers buy against the move, softening the blow. It keeps the ride smooth.
And right now,
We are losing our shock absorbers. We have a call wall, a concrete ceiling at 7,000. Dealers are short calls there. They will defend that level aggressively. It's going to be very hard to break back above 7,000.
And the floor, the line in the sand.
That is at 6,900. This is the put wall.
6,900. Why is this level so critical?
Because right now, at 6,900, the shock absorbers are still working. Dealers are hedged in a way that forces them to buy if the price hits that level. It creates a natural trampoline, a bounce.
But if it breaks?
If the selling pressure is too heavy and we smash through 6,900, the shock absorbers vanish. Gamma flips negative.
And what happens to the car without shock absorbers?
It bounces uncontrollably, or worse, the wheels fall off. If 6,900 breaks, dealers are forced to sell into the decline to protect themselves. It creates a vacuum. We could see the price accelerate straight down to 6,850 in a matter of minutes.
So 6,900 is the battlefield. If that wall holds, we bounce. If it cracks, we crash.
Perfectly stated.
Okay, looking at the charts, the technicals, the report says the trend is weakening. We're below the 10-day moving average.
We are, and we are fighting to hold the 20-day moving average at 69.35. Since today is Friday, the closing price is vital. If we close below 69.35 today, it confirms that the momentum is broken. The high-tight flag is dead, and we are in a descending channel.
So we have the setup. Yields are crushing valuations, the whales are short, and the floor is at 6,900. What do we actually do? The report gives us two strategies. Let's start with the one that seems to fit the current mood. Strategy 1, correction harvest.
This is the short play. The source gives this a setup grade of 4 out of 5 stars. It aligns with the trend.
So do we just short right here at the current price?
No, never chase. The strategy relies on human psychology. We know there are bulls trapped at the top. They're praying for a bounce so they can get out at break even.
The hope bounce.
Exactly. So the strategy is to wait for that bounce.
Yeah.
You want to short a rally into the 69.65 to 69.75 zone.
69.65 to 69.75. Why there?
That is the retest of the broken support. As price gets there, those trapped bulls will sell to save themselves. That selling pressure is your entry signal.
And where are we aiming?
First target is the current lows, around 69.35. Second target is that trampoline, the 6,900 put wall.
And the stop loss. We have to protect our capital.
Hard stop at 69.90. If it gets back to 69.90, the bearish thesis is wrong. You get out.
Okay, that's the sensible play. But I know some of our listeners love the adrenaline. What about the contrarian play? Strategy 2, the 6,900 defense.
This is the knife catch. It is riskier. The source only gives it 3 out of 5 stars.
But the logic is based on that trampoline effect we talked about.
Yes, you are betting purely on the mechanics. You are betting that when the price hits the put wall, the dealer algorithms will automatically buy to hedge.
So what's the entry?
You set limit buy orders at 69.05, just above the wall. You don't wait for confirmation because the bounce might be instant.
You are stepping in front of a freight train hoping it stops on a dime.
You are buying the fear, but you must be disciplined. The target is a return to the mean around 69.50.
And the stop loss. This seems absolutely critical here because of that negative gamma vacuum.
It is life or death for the trade. The hard stop is 68.80. If the wall breaks, you do not hope. You do not pray. You get out immediately because the vacuum below 6,900 will pull you down fast.
Get out before the shock absorbers fall off. Got it. So looking ahead to next week, Monday through Wednesday, February 2nd to the 4th, what does the report forecast?
The probabilities are tilted downward. They give a 55% chance of a bearish correction, a slow glide lower to test that 6,900 to 6,920 zone. The macro headwinds, specifically those yields over 4.25%, are just too strong for a V-shaped recovery right now.
Is there any chance we just shop around?
About a 30% chance. We could oscillate between 69.35 and 69.80 as the market tries to digest the worst news.
And the bullish breakout, the return to glory.
Only 15%.
Ouch. That is low.
For that to happen, we would need yields to drop immediately below 4.2% and a massive reversal in tech. It's the least likely outcome.
So the verdict is pretty clear. We are in a show-me phase. The easy money is gone.
You have to respect that 4.27% yield. It changes the gravity of the entire market.
Before we wrap up, I want to circle back to something you mentioned earlier, the connection between the money and the politics, because I think that's the real takeaway for the weekend.
It is the most fascinating part of the data.
Think about the picture we just painted. The market is pricing in the worst Trump policies via the bond market driving yields up. But at the same time, the smart money is shorting the broad index while actively moving capital into defense stocks.
Buying tanks and selling software?
Exactly. If the biggest players in the room are positioning for a physical, defensive economy, what does that tell us about their expectations for global stability? They aren't just betting on stock prices going up or down, they're betting on the state of the world.
It suggests they see a rougher, more frictional road ahead, not just for the SP 500, but for the geopolitical landscape.
Which is a heavy thought to leave you with, but hey, that's why we call it a deep dive. We don't just skim the surface.
Knowledge is power, or at least it's protection.
That's it for today. Watch that 6,900 level, keep an eye on those yields, and stay safe out there. We'll see you on the next one.